All right, so all that I ask here is that you try to stay with me, at least finish these last answers. So if we compare selling a covered call like to being the house at a casino, right? My favorite game here would be roulette. So if we do American roulette, right? There are 37 different like roulette squares. One of them is green, 18 of them are red, 18 of them is black, right? And we're just going to do the simple, like choose red or black. And if you're correct, your money's doubled or either you lose it all. So clearly 18 out of 37 is red, 18 out of 37 is black. So if you choose red or black, your chance of winning is 18 out of 37. But you can see that 18 out of 37 is less than half. It's a 48.6% chance of winning, right? You could double your money, like the person that's buying your thing could double their money, but they're probably not. There's a higher chance that the house wins here. So the probability that the person loses it all is 51%. Probability they gain some money here or double their money would be 48.7%. So that's exactly what it is with covered calls. The probability that a covered call goes your way isn't exactly 50-50, right? There's things that affect it, like some stocks are bound to go up because of earnings or something. But if we just think of it like if you think up or down, right? Up is 50%, down's 50%. If you just wanted to think that way, then you could say that up is clearly 50%, but then if it goes down less than the premium they paid you, you're still making money. So that's also part of your gain. So if it goes up or down a little bit, you're still making money. So you have over a 50% chance of winning in that scenario. And a lot of times, if people are paying a lot for a call, it's probably going to go up, right? So the thing here is casinos can they have to pay out this double money, right? So for the people that win 48.7% of the time, they have to pay out this money. But you don't have to. If it goes up, all that matters is your stock goes up as with the call. So if they shoot up and they get 5 times returns, it doesn't really matter to you because you don't have to pay that out. So compared to a casino, they can lose all their money. On this, you can't. The only way you lose money is if the stock goes down. And guess what? If it goes down, the person pays you as well. So if we say a casino, okay, the expected amount that a person would lose every time that they play roulette would be, we throw in a quick formula here, right? And we'll get 2.7 cents. And what that comes out to is 2.7% loss per play. So a casino, every play they're doing, they are gaining 2.7% back, right? Some of them they'll lose, some of them they'll gain. That's why the standard deviation here is 99 cents, right? Clearly, it's close to either they could gain $1 or they could lose $1, but it's a little less than like the max of that. The max of a normal thing would be like 98 cents. Like they're still gaining money most of the time. So that's what this expected value is for. So if you were a casino owner doing one of these roulettes, you would win, like you would get 2.7% profit per little spin. But if you are selling a covered call, you're just saying, okay, my covered call, I'd be getting 2.7% each, right? If we're going like it's almost a 50-50, but you gain a little more on a covered call, then here we can see that you'd be making like 2.7% per covered call, and covered calls can vary in price. So you could be making 5% a covered call. Now, I'm going to show you if you keep doing this, like if someone keeps rolling the roulette, the chance that they win. Like they get any money at all. So let's go do that. So what I have here is if you tried 2 times, right? If you did roulette 2 times, this would be like the person buying the bid. And then if you did roulette 1,000 times, your chance of breaking even or winning. And it's basically just winning money. Okay, so if we're saying we're on the other side of this, we want them less than half of the time to win money because that means we win over half the time, right? And in actual covered calls, your probabilities are much higher. Your chance of winning money is so much higher, and the chance of another person losing money is also so much higher. Because here they can only double their money, but on a call, they can literally infinitely gain money. The good thing is you're not the one paying that. So therefore, they have to pay you a higher premium, and they also have a higher chance of losing it. So clearly, this is just roulette, but in our situation, you'd be getting more money, and it'd be more of a chance you'd win. Okay, but in roulette, if you spun it 2 times, the chance that you'd actually get money would be 48.5%, which is a little lower than just winning once, right? Winning twice is less chance than if you just won once. So clearly, they're still going to make money most of the time. And that means if you were the house, you might lose money, but a lot of times you'd still make money. Here, though, if you did it 1,000 times, like if you just keep selling covered calls or keep letting people spin this roulette wheel, right? The chance that they end up making money in the end, right, is 19.5% on a roulette wheel after 1,000 tries. So instead of being 48.5% chance of them making money, you just do it 1,000 times, and then it's only 19.5% chance of making money. So, as we said, the probability that a call actually executes and you make money, because the chance it goes way down is not very big, given that it's already a stock you want to buy at the price it's at, right? So you don't really care if it goes down. If it goes down, you just take that premium and just like eat it up, right? If it goes up, the thing that's different than a casino is you don't have to pay this upside. And if it goes down, well, you just get all their money. And what I'm trying to say here is the chance that you get money off of a covered call, if it's a well-chosen covered call, a covered call on a stock you want to buy at a price you want in a time limit you think fits your plan, then it's probably like 80% or higher amount of time you gain money. And if you just hold on to the stock and it's like a good company, it'll probably bounce back and you'll make money like 100% of the time. But here you can see the house always wins, right? Only 19.5% of the time after 1,000 tries would the house not win. And the more tries they do, right? Clearly, a casino doesn't just roll a roulette 1,000 times. They roll it like tens of thousands of times, right? So the chance that they would lose money overall would be so small. So here, clearly, on like the house always wins. And if you're thinking about stocks, right, the house also always wins, because even if the stock goes down, you get money from the premium, and if it keeps dropping, well, you can sell another call to bring it to get more premium, right? It just doesn't matter. You're just winning. So even though the house wins here, I'm saying that covered calls are better than even being the house for gambling. They're like, the house always wins. But have you ever tried getting a higher gain and at a higher like chance of actually winning? That's covered calls. So that's exactly why I think covered calls are like the best thing ever.